Hello, uh, a very good evening, all of you. Assalamu alaikum, wanakkam, aibovan, vandanam. I hope you all been having a good time. It's been raining abnormally, but then again, it's good, it's good to end the year with the rain so that we all would find serenity in it. So, this is our second weekly paper. So, the plan is to complete the weekly paper that I uploaded. Basically the accounting equation. We will be completing the accounting equation question first. And if time permits us, we will be able to discuss the remaining MCQs that we had left last week. So that is the plan for today. So I gave you a weekly paper to give you a little bit of a tidbit about this question. To be really honest with you, this question was basically the accounting equation question that the previous A-level students did in their final exam. So this was basically the accounting equation question of the 2023 batch, the latest past paper, not the batch that is currently doing the exams. They are having the exams probably in another 10 to 15 days time. This is basically your last, not the senior, basically your super seniors examination paper. So I haven't basically taken the question and given it to you. I have made a bit of changes to the question. I have made some adjustments to the amounts, and also I have basically made few adjustments a little more harder than what it was being tested in your final exam. Okay, so I hope you have the weekly paper with you, maybe in the form of a PDF or maybe as a physical document. So this is basically the second weekly paper that we are about to discuss. So this is in fact a question that, as I already told you, tested in your super seniors final exam, which is 2023. But then again, I have made some adjustments. For example, if you take a look at the numbers, it won't be as same as the past papers, okay? Because basically I have changed the numbers a little and also have made a little bit of changes. For example, here, using honest personal cash, I have included that just to make the question a little more standardized, okay? So that's the intro regarding the question. So without wasting any time further, let's get into the discussion. So there are three requirements. There are in fact three requirements. They want us to record the transactions, all those 15 transactions in the accounting equation, which is basically on the left side. Okay, so this is the accounting equation. And then they have requested you to prepare the statement of profit or loss, in other words, income statement. So the income statement is here. Okay, and then they want you to prepare the statement of financial position, that is basically at the right corner. So on your left, you have the equation. Smack in the middle, you have the income statement. On your right, you have the statement of financial position. So, right, let's get it started. So what's the first thing we must do? We must record the opening balances. So this is something we all can unanimously agree on. Despite the question you do, if opening balances are given, you should record the opening balances first. Despite the question you do. It could be a question with regards to accounting equation. It could be a question with regards to prime entry books. It could be bank reconciliation statement, you name it. If opening balances are given, you must take into account the opening balances first. That's a rule of thumb, if you like. So let's start recording the opening balances. So what I would do, next to the transaction number, I will say OB, indicating my opening balances. So I have PPE 4,000. Then we've got inventory 350. Trade and other receivable, that's 500. We have cash 50. The company has obtained a bank loan, that is 1,000. We have trade and other payable, that's a minor figure 70. And then we have equity, which is 3830. Okay, so these are the opening balances. These are the opening balances. So as I already told you, let me reiterate it one more time. In accounting equation, if opening balances are given, you gotta record the opening balances first. Rule of thumb. Keep it in the back of your head. Make sure that you record the opening balances first. Now, let's get into the first adjustment. What is it? A land worth 800,000 and cash 300,000 were invested by the owner as additional capital. So now what does the owner do? Owner is investing 800,000 worth of a land, and he's also investing 300,000 worth of cash into the business. Okay. So now how are we going to record it? So basically the owner is investing a land. The owner is investing a land. If owner invests a land, now we got to decide, is land considered inventory or is that a PPE? So what is the difference between PPE and inventory? Very simple. Inventories are resaleable items. Inventories are resaleable items. Property, plant and equipments are usable items. If you take Food City, what do they buy and sell? Groceries. Therefore, groceries are considered as inventory. If you take Dumro, what do they buy and sell? Furnitures. So the inventory of Dumro is basically furnitures. So whatever the goods that are bought and sold are ideally categorized as inventory. Then you have property, plant and equipment. Basically the usable items. For example, the land, right? Building, motor vehicle, furniture and fittings, computer equipments, machineries, office equipments, you name it. All these usable items fall under property, plant and equipment. In this case, what does the owner do? The owner is investing a land worth 800,000. So what happens to property, plant and equipment? It increases by 800. It increases by 800. And also the owner is investing another asset. What is it? Cash. If owner invests cash, cash flows into the business, isn't it? So cash is also increased by 300. Cash is also increased by 300. Now, that is the first impact. What is the impact? Asset increases. So two types of assets are being increased. Property, plant and equipment, basically the land, and then the cash, both increases. And this 800 and 300, who's investing this? Is it an outsider or is it the owner? Basically, two people can provide resources to the business. You know that. Two people or two groups of people can provide resources to the business. You have the owner, then you have the outsider. For example, outside is a bank, owner is basically the owner. In this case, who's providing the resources? Is there an owner or outsider? If it is an outsider, it is a liability. If it is an outsider, it's a liability. Is this the owner or outsider? It's obviously the owner. Therefore, this should increase our equity. Therefore, my equity will increase by 1,100. Therefore, my equity will increase by 1,100. Did you understand? So that's basically the first adjustment we got. Now, wait a minute. There is something that I missed. While you are attempting this question, while you are attempting accounting equation, if they ask you to prepare the income statement and SOFP, listen to me very carefully. When it comes to accounting, it's not just about understanding the subject matter. It's not just about understanding the subject matter. It's about understanding the technique as well. So there are many techniques that could be used as you do certain types of questions. When it comes to accounting equation, if the examiner asks you to prepare the income statement and SOFP along with the accounting equation, let me tell you what you should do. You have to do the income statement and SOFP together. You got to do the income statement and the accounting equation. You should do the accounting equation and income statement simultaneously. Every time you record of something, every time you record of a transaction, just ask yourself, is there an income or expense? Is there an income or expense? Because we know in the income statement, what do we take into account? We take all the income and the expenses. We take all the income and the expense. So every time we record a transaction, we got to ask ourselves, is there an income? Is there an expense? If the answer is no, never mind, you can basically proceed with the next question. But if the answer is a yes, as in if there is an income or expense that you have recorded here, it should be recorded in the income statement immediately. Don't do this and then come to this and then finally go to that. Do this and this together. Do you understand? Do the equation and income statement together. That's a technique you are using. That's a tip. Okay. So now, in the first transaction, do we have an income or expense? No, it's not an income or expense, right? This is additional capital. Additional capital is not an income. So you can skip and proceed to the next question. Okay. So now, what is the second question we got? Second transaction we got. Goods with a list price of 1,250 were purchased on credit. A trade discount of 50,000 was received in this respect. Guys, focus on this trade discount. Goods with a list price. Okay, goods with a list price 1,050 were purchased on credit and a trade discount of 50,000 was received in this respect. So let me ask you, trade discount, do we make any entries for that? Do we make any entries for trade discount? Yes or no? Good. Very good, Ruqayya. Very good, Aliza. Very good. Very good, Abdullah. Very good, Rashika. Well done, Hikma. Right. Very good. Okay, some of you are saying yes, some of you are saying no. Let's not waste time. The answer is no. The answer is a clear no. You do not take into account the trade discount. So now you might be like, sir, in which chapter we learn this? In which chapter we learn this? We learn this in primary books. In primary books, we all know we learn sales, purchase journal and all. Right? While we are doing those journals, we learn this tangent, the difference between trade discount and cash discount. So what is a trade discount? A discount that is granted or received, a discount that is allowed or received when the goods are being bought and sold. While buying and selling, if a discount is either allowed or received, it is basically a trade discount. In accounting, you do not make any entries for that. Don't make any entries for trade discount. When buying and selling, if the buyer or seller was to grant a discount, that should not be taken into account. You got to completely omit it. But the cash discount, when do we offer a cash discount? It's when we settle the due amount to the trade payable, or it's when trade receivable settle the due amount to us. If we are to allow or receive a discount while the trade receivable or trade payable settling their due amount, that's a cash discount that needs to be taken into account. So keep in mind, cash discount, trade discount, we make entries for cash discount, but we don't make entries for the trade discount. When can we witness a trade discount? It's when the goods are being bought and sold. If a discount is being applied, that's trade discount, omit it. Don't record it. What is a cash discount? It's when the trade payable or trade receivable is settling their due amount. If a discount is either allowed or received at that point of trade receivable and trade payable settling their due, that's cash discount. Make entries for that. In this case, what are we doing? Are we settling to a trade payable, or is a trade receivable basically settling their money? No, it's basically a purchase. We are purchasing a good with a list price of 1,250. So listen to me very carefully. The list price is 1,250, and to the list price 50,000 worth of a trade discount is allowed. So what is my actual purchase price? My actual purchase price is 1,200. And do you take into account this 50? No, not really. Don't think of the list price. Do not think of the trade discount. Record this as a purchase. Record this 1,200 as a purchase, right? So in this transaction, we are purchasing an inventory. So my inventory goes up by 1,200. 50, don't take into account. This 1,200, is it paid or payable? This 1,200, is it paid or payable? It is payable. Because if you read through the transaction carefully, they tell you goods with a list price of 1,250 were purchased on credit. It was purchased on credit, which means is it paid or payable? It's payable. Therefore, I need to increase my liability. I got to increase my liability by 1,200. Again, sir, do we make any entries for that 50? Please don't take that 50 into your calculations. Do not take that 50 into your calculation. Just pretend as if it doesn't exist. Pretend that discount doesn't even exist in this world. So that's trade discount. Are we good with this question? I hope we are. Sir, we should record this in SOPL. Right. Now, that's the second step that we are coming into. So we have recorded the second transaction. Now we need to ask ourselves, are we going to record this in the income statement? The question lies in one criteria. The question lies in one criteria. Is there an income or expense? Is there an income or an expense? If there is an income or expense, you can take this into the to the income statement or the SOPL. But again, in the second question, we do not have any income or expenses. We don't have any income, neither do we have any expenses. Because if there is an income or expense, your equity should get affected. If there is an income or expense, your equity should get affected, but it didn't. Can you see? The equity didn't get affected. Therefore, you can simply omit and proceed to the next question. Okay, so let's move on to the third transaction. What do we got? Goods costing 700,000 was sold for 1,500 on credit. Goods costing 700,000 was sold for 1,500 on credit. So guys, this is something very straightforward. We don't want to waste a lot of time. What are we doing? We are selling goods. We are selling the resellable items. That is inventory. So my inventory comes down by 700. My inventory comes down by 700. For how much am I selling this? I'm selling this for 1,500 on credit. I'm selling this for 1,500 on credit. So did I receive cash or is the amount still receivable? Did I receive cash immediately or is the amount still receivable? The amount is still receivable. Why? Again, they are mentioning the term on credit. Goods costing 700,000 was sold for 1,500 on credit, which means the amount is still receivable. So can you add the cash? No, you can't add the cash. Instead, you need to add the trade receivable. So I will increase my trade receivable by 1,500. Right? And what is the profit that I'm making here? What is the profit element that I'm making here? I'm making 800,000 as my profit, which should increase my equity. I make 800,000 as my profit, which should increase my equity. Okay. Right, sir, but purchase of goods, won't it come under cost of sales? Amna, it's a very good question. Amna, it's a very good question. So Amna is asking, sir, when we purchase goods, does that come under cost of sales? Yes, it comes under cost of sales while you are doing questions like sole trader, questions like partnership, questions like companies. While you're doing such questions, we need to take the purchase of inventory under cost of sales, because we know under cost of sales, there is a specific regime that you should follow. As in there is a working that you should follow in order to find out the cost of sales. What do? You take the opening inventory or opening stock and you add the purchase and you minus the closing inventory, don't you? While you are attempting sole trader, partnership, companies, you have to take the purchase under cost of sales working. But here, you don't need to. Here, you don't need to. You just need to record the sales, cost of sales, gross profit part when you sell inventory. Until you sell an inventory, Amna, you don't need to record anything over here. While buying the inventory, should I take it to the cost of sales? No, you don't need to. Okay. So cost of sales calculation needs to be performed in chapter number 5. So no, chapter number 6, sole trader, or else partnership, if not companies. Until then, with this, you just need to record it whenever an inventory is sold. Okay. Right, that's a good question, by the way, Amna. I appreciate it. Such a good question. Okay, don't react to right. Okay, Adlan sir, noted. Okay, right. So now question number 3. No, transition number 3. Do we have an income or expense? Can I get a quick response from your end? Please, quickly. Do we have an income or expense in transaction number 3? Very good, Umair. Yes. Okay, brilliant. We do have. Very good, Amna. Once again, very good, Hafsa Razik. Very good, Rishda. We do have an income, right? Now we gotta understand the system of SOPL. I think you might have learned this with your previous lecturers, but then again, a very quick idea, right? This part, we call it the main activity of a business. This part, we call it the main activity. What is the main activity of a business? Selling inventory. What is the main activity of a business? Selling inventory. So this part is specifically designated for recording the income and expense of selling inventories. And other than that, every damn thing needs to be taken to the latter part of the statement, which is the activity. Other than selling inventory, every other income and expense needs to be recorded over here. Other income, other expense. If it is a transaction with regards to selling inventory, it is considered as main activity. Take it to the top part of the statement. So that's something you all might have learned in whichever the accounting class that you have been following. I believe in that. Okay. So now the cost of the inventory is 700. The amount for which the inventories were sold was 1,500 and the profit I made was 800. Now, what's my sales figure? My sales figure is 1,500. For how much am I selling it? I'm selling it for 1,500. What's my cost? My cost is 700. What's my profit? My profit is 800. Did you understand? So for how much am I selling it? I'm selling it for 1,500. And what's my cost? My cost is 700. And what's the profit I'm making? I'm making 800. That needs to be recorded then and there. So you need to do the equation and the income statement together simultaneously. Whack it off. Okay. So that's the way you record it in the income statement. So let's move on to the fourth transaction. Furniture costing 600,000 was purchased for the use of the business. 400,000 was paid in this respect on the same date and agreed to pay the balance in May 2023. What are we purchasing? We are purchasing a furniture, aren't we? We are purchasing a furniture. And we are basically paying 400,000 instantaneously. Then and there, 400,000 is paid. And the balance is going to be paid in May 2023, which means in the next month. We are doing the statement for April. Guys, there is a small mistake here. This is not 2024. This should be 2023. Yeah? This should be 2023. So we are recording the transactions for April. Okay, we are recording the transactions for April. And this amount is going to be paid in May. This amount is going to be paid in May. Okay, so it's going to be paid in May. So now we need to figure out, is this a long-term liability or short-term liability? Can you answer me? Is that a long-term liability or short-term liability? If we are going to pay that in May. Very good. Ruqayya. Very good, Khalid. Very good. Very good, Umair. Very good, Afzal. Yes, it is a short-term liability. It is a short-term liability because we are preparing the statements for the month of April, and we are planning to pay the remaining amount of this particular transaction in May 2024, which means we are going to pay that in the immediate month. Or the next month. We are basically paying it the next month. So is it a long-term liability or short-term liability? It's a short-term liability. So as long as you know that, it's very easy to get this transaction done. Okay. So we are purchasing What are we purchasing? We are purchasing furniture. The cost of furniture is 600. You know, furniture is property, plant, and equipment. Let me increase the PPE by 600. Let me increase the PPE by 600. Out of this 600, 400 is paid. So out of 600, 400 is paid. My cash will go out by 400. My cash will go out by 400. So out of 600, 400 is paid. The remaining 200, is it paid or payable? It is payable. When is it going to get paid? It's going to get paid the next month. It's going to get paid the next month. So if you put this under bank loan, you are wrong. If you put this under bank loan, you are wrong. Why are you wrong? Because this is going to be paid the next month. Loans are long term. Payables are short term. Keep in mind. There are two terms that you often come across as far as liabilities are concerned. We have payables and we have loan. Loan are generally a long-term obligation. Payables are generally a short-term obligation. So if you put this under bank loan, you are wrong. The remaining 200 should come under trade and other payable. It should come under trade and other payable. There you go. So we are purchasing a PPE for 600. Out of 600, 400 is paid immediately. The remaining 200 is going to get paid the next month. Therefore, it's a payable. Take it to the trade and other payable account. I hope you understood, right? So let's move on to transaction number 5. Goods costing 30,000 purchased during the month were returned to the supplier. This is something you guys are like very familiar with. 5th transaction. My goods go out because this is purchase return. And my trade payable goes down because purchase return reduces my trade payable. So my inventory comes down and my trade payable comes down as well. So let's move on to question number 6. Again, no income and expense. So I don't want to sweat a little. I don't want to sweat much because there's no income. There is no expenses. Now, 6th transaction. Goods sold for 50,000 during the month were returned by a debtor. The cost of these goods were 20,000. Okay. So now, is this purchase return or sales return? This is sales return. This is sales return. So guys, goods are being returned by a debtor. Goods are being returned by a debtor, which means it's a credit sale that was done previously, and now it is getting returned by the customer, right? So the selling price is 50, the cost is 20. What are we going to do? Listen to me very carefully. Just a very quick shortcut. If you sell, what do you do? If you sell in transaction number 3, in the 3rd transaction, what did we do? We sell. The 3rd transaction, we sold. When we were selling, we reduced the inventory. When we were selling, we reduced the inventory. Now the sold goods are getting returned, which means I should add back my inventory by 20. Because you know, inventories are valued at stock cost. Inventories are valued at stock. So what I would do, when I sell, inventory goes out. When I sell, inventory goes out, so I decreases my inventory. When the sold goods are returned, now the inventory comes back in. The inventories comes back in. So what am I supposed to do? I should increase my inventory. And when we sell, what do we do to the trade receivable? I increase my trade receivable. Why? Because now the customer should pay me. Now, if the goods are getting returned, what am I supposed to do? I should reduce the trade receivable back. So let me reduce it by 50 by the sales value. Because trade receivable is valued at sales. And now, what is the loss am I making here? What is the loss am I making here? I'm making a loss of 30. So when we sell, we increase the equity because there is a profit. When we sell, we increase the equity because there is a profit. When the goods are being returned, there is a loss. Therefore, I must reduce my equity. I must reduce my equity. So simply do the right opposite of selling. Do the right opposite treatment for selling inventory if the inventories are going to get returned. We reduce the inventory by cost. Now we increase the inventory by cost. We increase the trade receivable by selling price. Now we reduce the trade receivable by selling price. We increase the equity by profit. Now we decrease the equity by loss. I hope you understood. So now, a very quick question to ourselves. Is there an income or expense? Yes, there is an expense. Now, there is an expense. Now, what am I supposed to do? When we sell, we increase the sales. When we sell, we increase the cost of sales. When we sell, we increase the gross profit. Now do the opposite. Now do the opposite. We increase the sale. We increase the cost of sale. We increase the gross profit. That's what we did, didn't we? Now, I should decrease my sale by 50. I should decrease my cost of sales by 20. And I should decrease my gross profit by 30. Should decrease my gross profit by 30. Just do the right opposite to sales. Okay. Okay, I hope that is clear. We've got MF Abdullah asking us to re-explain the 6 transactions. So, Abdullah, what happens here is basically the sold goods are getting returned. The sold goods are getting returned. So, when we sell, what do? We decrease the inventory by the cost value. We decrease the inventory by cost value. Now, if the sold goods are returned, what am I supposed to do? I should do the right opposite. I have to go other way around. As in, I should increase the inventory by the cost value. And when I sell, what do? I increase the trade receivable by the sales value. Don't we? That's what we do. So now the goods are being returned. If goods are being returned, you got to do the right opposite. Now decrease the trade receivable by the sales value. And when we sell, what do? We increase the equity because it is a profit. And now if it is not going to get returned, I should decrease the equity because now there is a loss. Did you understand, Abdullah? So now that needs to be recorded over here as well. Just do the right opposite to sales. When we sell, we increase the sales. Now decrease it. When we sell, we increase the cost of sales. Now decrease it. When we sell, we increase the profit. Now decrease it. That's what you should do. Very good, Abdullah. Barakallahu fi. Right. Let's move on to the 7th transaction. Paid monthly loan installment 80,000 for the bank loan. This installment includes an interest of 25,000. Okay. That's a cheesy one, I guess. So what are we doing? We are paying installment. Installment includes the loan value, the capital loan value, and it also includes interest. So the installment that we are paying is 80. It includes interest of 25, which means my loan amount is 55. My loan amount is 55. Isn't that true? So if I pay installment, what happens to my cash? My cash comes down, right? Loan is a liability. My liability also goes down. And interest is an expense. Expense reduces my equity. Expense reduces my equity. So this is something you should be like very familiar with, right? So let's not waste time. Let's go to the 7th transaction. Let me minus 80 from cash. That's the installment that I'm paying. Out of 80, 55 is my bank loan, which is the loan amount, and the remaining 25 is equity. Remaining 25 is equity. So the same thing being applied over here. Now, a question comes to our mind. Is there an income or expense? There is an expense. Is there an income or expense? There is an expense. Now I'm going to put this to you. Answer me. Is that an expense stemmed out of the main activity? Or is that an expense with regards to other activity? Is it the top of the table or is it the latter part of the table? Very good. Very good. Well done. Well done. Well done, Sheena Shahani. Very good, Fatima. Very good, Hasna. Well done. Well done. Very good, Amila Faisal. Very good, Rishda. Very good, 25JM757. Right. Very good, Afzal. Very good, Fatima. Amna Nazir. Well done. Well done. Well done. It's other, right? So you can't record it over here. You got to come down. Is that an income or expense? It is an expense. Interest. Right. That's 25. So I can indicate it with a bracket because it is an expense, right? Now, let's move to the next transaction. A land of the business with a carrying amount of 1 million was sold for 1.7 million in cash. Okay, guys, most of the students, because I kept this as a unit test for 2026 batch. I kept this question as a unit test for 2026 batch. Most of the students made a mistake here. Most of the students, although they know the tangent, although they know the logic, they still, out of hastiness, messed it up. What are we selling here? Are we selling inventory or are we selling a property, plant and equipment? It is a land. They didn't mention goods. They mentioned land. So what are we selling? Exactly. We are selling property, plant and equipment. We are selling property, plant and equipment. Guess what the students did in your junior batch, 2026? Most of them considered this as an inventory and they busted the inventory down. You can't bust the inventory down, guys. Why can't you bust the inventory down? Because in this case, you are not selling an inventory, but you are selling a property, plant and equipment. So you need to reduce the PPE and then do the necessary adjustments, right? So the carrying amount of PPE is 1,000. They are selling a land worth 1,000. So you need to reduce the property, plant and equipment by 1,000. Okay. For how much are we selling this? We are selling this for 1,700, but this time, thank God, we are selling it for cash. So I'm going to increase it by 1,700. And what's my profit? My profit is 700. Now, we are confused. Most of us are going to get confused. We have an income. We have an income. And that income is stemmed out of selling. That income is stemmed originated. That income stemmed out of selling. And sir told us, selling kiyala avut, it should go to the top part of the statement. But I'm asking you, can you take this 700 to the top part of the statement? Can you do so? Very good, Hasna. Very good, Arham. Very good, Zahra, Ruqayya. Very good, Nalir. Well done, Umair. Hasna, I think you guys are pro. You guys are pro. Very good, Amila Faisal. That's a beautiful, answer. No, because it's non-current asset. Very good. Very good, Umair, Faisal. It's not related to inventory. It is not related to inventory. Therefore, you can't take it over here. It should be other income. So I can say PPE, let's say disposal profit. PPE, disposal profit. How much is it? That's 700. That is 700. Okay. Right. Next. Okay. 800,000 cash was received from a debtor after allowing a discount of 20%. Okay. Those of you who have done this question, those of you who have attempted this question, do you mind letting me know what is the discount figure? Can you let me know what's the discount figure? Very good, Amila. Very good, Hafsa. Good, good. Okay, okay. Oh, Yasmin, what happened? Last week couldn't see you in the class. Hope you're doing good, Yasmin. Okay, we got some people saying 200. Okay, we got some people saying 200, and then we have got some people saying 160. Now that's gonna confuse us a little, right? There are some people saying 200, then we've got some people, I don't want to mention names, they have basically stated 160. If you have gotten 160, you are wrong. If you have gotten 160, you are wrong. I shall explain you why you are wrong. Wait a second. I shall explain you why you are wrong. Listen. 800,000 was the cash we received from trade debtor. So this is not the total amount receivable. This is not the total amount receivable. This is basically the cash that we received after the discount, after allowing 20% discount. So now most of you have taken 160 as discount. It is wrong. If you have taken 160 as discount, it is wrong. Let me put that in both so that you would be able to understand it better. Very good, Hasna, very good. Spot on. Your adjustment is 100% correct. Okay. So let me explain this to others as well. I'll keep this over here in case if you need it. So now we have trade receivable. That is the total amount receivable. Hari. And what are we doing? We are allowing a discount. And we are receiving cash. And the amount of cash we received, how much is it? It's 800. The amount of cash we received is 800. And the discount that is being applied over here is 20%. Discount that is being applied over here is 20%. Now, listen to me very carefully. The discount being applied is 20. So we all know percentage is calculated based on 100. Percentage is calculated based on 100. This is basics. This is basic math. This is basic math. If I'm to tell you, you need to drink 50% water out of this water bottle. If I'm to tell you, you should drink 50% of water out of this bottle. What do I mean by that? I consider this water bottle to be 100%. Okay? I consider this water bottle to be 100%. Consider this to be 100% and drink 50 out of it. Consider this to be 100% and drink 50 out of it. So whenever a percentage is calculated, it is calculated for 100. It is calculated for 100. 100 is the base value. 100 is the base value. Out of 100, you can determine 20, 30, 40, 50, 60, 100, whatever the amount you want. So now, trade receivable is basically the base value, that is 100%, right? Trade receivable is represented by 100. Okay? Out of 100, we are giving 20% as discount. So the money that we received is equivalent to 80%. The money that we received is equivalent to 80%. Very good, Rishta. So now, if you calculate 20% for this 800, you are wrong. I'm sorry, but you are wrong. I'll tell you why you are wrong. Because this 800 is the discount deducted figure. The discount has already been deducted. So should you be charging discount over discount? No, you don't. Do I make sense to you? So now I need to go reverse. It's reverse process. I should go back all the way to 100%. How do I go back to 100% all the way? This 800 is represented by 80%. How much is for 100? I will get 1000. So what's my trade receivable value? My trade receivable value is 1000. And what's my discount value? My discount value is 200. My discount value is 200. So now you may wonder, sir, like, can you explain this calculation as well? Now 800 is represented by 80%, right? 800 is represented by 80%. So if I divide 800 by 80, I'll get 1%. If I divide 800 by 80, I get 1%. So 800 divided by 80, I will get my 1%. I think that is 10. That is 10. So if I divide 800 by 80, I get 10, which is represented by 1%. Extrapolate that 1% to 100, I will get 1000, which is my trade receivable. So now it's just a matter of recording that in this part. So what is the total trade receivable that is being settled? It's 1000, isn't it? 1000 is being settled, but the cash that we are receiving is 800. And 200 is basically discount allowed, which reduces my equity. 200 is discount allowed, which reduces my equity. Again, pause for a quick second there. This 200, yes, this 200, is that an income or expense? It is an expense. May no other, it's other expense because it is not selling. Discount allowed. How much is it? That's 200. Beautiful. Beautiful. Okay. Right. Well done, Hasna. I think some of you got it as 120. Eka varadi kiyala me hitagatana hati. Okay, that's the point you need to understand. Superb. So now let's move on to the next transaction. What is it? Goods costing 4,000 were purchased for cash. Only half of the amount is paid. That's quite straightforward. We are purchasing goods 400,000. So let me increase by my inventory by 400,000. Out of 400, half is paid. 200,000 is paid. The remaining 200 paid or payable? It is payable. So let me increase my trade and other payable. Let me increase by trade and other payable. So I'm purchasing goods costing 400,000. So my inventory goes up by 400. Out of 400, I paid 200. So my cash comes down by 200. The remaining 200, is it paid or payable? It is payable. So it's trade payable, increasing. Okay. Ask yourself, do we have an income or expense here? No. We neither have an income, nor do we have an expense. So proceed to the next transaction. Let's not waste time. Okay. Goods of the business costing 50,000 were obtained by the owner for his personal use. So drawing. What does the owner draw? What does owner draw? Owner is drawing goods, which means my inventory goes out. And if owner draws, it reduces my equity. So let me bring down my equity 50. Let me bring down my equity 50. Guys, answer me. Should I take drawing to the income statement? Should I take drawing to the income statement? Yeah. Okay, we've got some people saying expense. How drawing becomes expense? No. It can be treated as expense. Okay. It cannot be treated as expense, guys. You shouldn't be treating that as an expense. Okay. Because it is not an expense. You know, equity can reduce for two reasons. Equity may decrease for two reasons. One for the expenses, the other one for drawing. Expense, drawing, both reduces equity. But are they same? They are not same. Drawing is something owner takes or consumes the assets of a business for his personal consumption. Owner is basically taking the assets of a business for his personal use. Expenses through the business activities, the business is losing. So although both reduces the equity, they are not the same. So do not take drawing into income statement. If you take so, you are wrong. Don't take the drawing into income statement. So let's proceed to the next transaction. 12. 12. Okay. 200,000 payable to a trade creditor was settled subject to a discount of 50,000 using owner's personal cash. Now, a good transaction one more time. This is kind of a improvised one. So we are settling 200,000 worth of trade payable. So my trade payable goes down by 200. My trade payable goes down by 200. Okay. So to settle this 200, wait a second, let me write it a little bigger than this. So my trade payable is getting settled by 200. To settle this 200, tell me what is the amount of cash being used? To settle this 200, what is the amount of cash being used? $150. Yes, correct. Very good, Fatima. Very good, Hafsa. Very good, Rashika. 150, right? 150. That is the amount of cash being used. But answer me. Are we using the cash of the business or are we using the cash of the owner? We are using the cash of the owner. Hold your horses. Do not jump the gun. Just listen to me very carefully. Pay attention to what I tell you. We are not using the cash of the business. Rather, we are using the cash of the owner. So it is not the business that is settling this trade payable. It is basically the owner who's settling this trade payable on behalf of the business. Okay. Now there is a difference. There is a difference. Listen to me. So now I will write it over here. We have Nifran. Okay. Nifran is having a business called, let's say, NIF Traders. Okay. You got to understand in accounting, NIF and NIF Trader, both are two different things. They are not the same entity concept. NIF Trader and NIF, they are two different things. They are not the same. Okay. Now, business has a transaction. business as a transaction. So now this transaction needs to be sorted by the business, right? This transaction needs to be sorted by the business. But the business is not sorting this transaction down. The business is not sorting this transaction down. Instead, Nifran steps up the game and sort this transaction from his end. Although it should be sorted by the business, Nifran sort it out for his business. Whenever owner does this, it should be treated as additional capital. Whenever owner spends on behalf of the business, very good, Umair, it's entity concept, very good, okay? Whenever owner spends on behalf of the business, it should be considered as additional capital, because does he directly invest cash into the business? No, he doesn't invest cash into the business. Rather, he is spending on behalf of the business, which is more or less the same. So if you reduce 150 over here, you are wrong, guys. If you reduce 150 over here, you are wrong. Why you are wrong? Because we are not using the business cash. The cash that is being used is basically the owner's one. Therefore, if owner spends on behalf of the business, it should be treated as additional capital. Therefore, I should increase my equity by 150. I should increase my equity by 150. And hold on a second. There is an income over here. There is an income over here. How much is it? There is a discount, right? Right. Exactly. We have a discount of 50. Income, what does it do? It again increases my equity. It again increases my equity. So this is discount received. This is the amount the owner paid, treated as additional capital, and both are being used to settle the trade payable. Are we good here? So that's basically transaction number 12. Let me tell you one more time. 200,000 worth of trade payable being settled. To settle this 200,000 worth of trade payable, 150,000 is being used by the owner, treat it as additional capital, and the remaining 50 is a discount. It increases my equity. Okay, please let me know if you have any doubts so that I can re-explain that to you. So this is basically a beautiful transaction from my end to you. Okay, one more time. We are settling 200,000 worth of trade payable. All goes down. To settle this, we are using 150,000. Again, we are not using our cash, so I can't reduce the cash of the business. But we are using the cash of the owner, treat it as additional capital, and there is 50,000 discount received. Okay, now, what's next? We have an inventory costing 90,000 was destroyed, and the insurance company has agreed to pay 80% of this loss. This is they have taken the sole trade adjustment, and they have basically given it to you, right? Look, the inventory is being damaged is 90. Inventory is being damaged is 90. Out of 90, 80% is guaranteed to be received by the insurance company. So that is insurance receivable. It's 80% or 20%. Give me a second. I think it is 80%, right? So 80% is going to be received from the insurance company. So look, 90,000 is the total inventory being damaged. 80% is going to get compensated by the insurance company. That is 72,000. Okay. So insurance company is going to give me 72. They haven't given me. They agreed that they will be giving it to me. So out of 90, 72 is being received. Is going to be received from the insurance company. 18,000 is my loss. 18,000 is my loss. Okay. So now my inventory goes down by 90. My inventory goes down by 90. Perfect. Out of this 90, 72 is going to be received from the insurance company. Therefore, it is a receivable. Out of 90, 72 is going to be received from the insurance company. Therefore, it is a receivable. So out of 90, out of the total loss we suffered, 72 is going to be compensated by the insurance company. Therefore, we can mitigate the loss. We can mitigate, nullify it. We are nullifying the 72,000 loss through the insurance company. The remaining 18, we can't help it. 90,000 worth of stocks being damaged, 72, perfect, insurance company agreed to pay. The remaining 18, we can't help it. It should be a loss. Therefore, it reduces my equity. So 90,000 is the total inventory being damaged. Out of 90, 72,000 insurance company agreed to pay me. They still haven't paid it. They said they would give it to me, which means, is it received or receivable? It is a receivable. So out of 90, 72 is going to be received in the future. The 18 is the loss that we are suffering, although we lost 90,000 worth of inventories. Okay, good. So now, do we have a loss? Yes, 18. It's an expense, may no other. It's another expense. We can say stock loss. That's 18. Okay, right. Now, 14. Operating expenses 600,000 was paid for the month of April 2023. Straightforward. Let's not waste time. My cash goes down by 600. Operating expense reduces my equity 600. Operating expense, that is 600. And then the last one, depreciation 120 was provided on PP as annual depreciation. 15. Depreciation, what does it do to our property, plant and equipment? It's 120, right? So if okay, wait. I think I missed out something. Sir, in transition 12, other income should be increased by discount received 50, right? Oh, yeah. Thank you, Hasna. Thank you. Thank you, Zakia. Thanks a lot. Oh, yeah. Guys, extremely sorry. I missed out one thing out of, some rush. There is this 50. It is an income, right? This 50 is an income. Discount received. It should have been recorded as another income. Extremely sorry. Out of the curiosity to explain, I forgot it. 50. Thank you. Thank you, Hasna, and thank you, Zakia. That's so nice of you. Thanks a lot. Right. Umair, happens. True. But anyway, it shouldn't happen to a lecturer, by the way. Cool thing. Right, guys. Mitra Balanda, depreciation 120,000 was provided on PP as annual depreciation. You can't take the annual depreciation here because we are doing it for a month. So if you take 120 as depreciation, you are wrong, right? What do you need to do? You need to divide 120 by 12 and you need to take 1 month depreciation, that is 10. So let me reduce PP by 10 and depreciation is an expense. Let me reduce my equity by 10. So depreciation is another expense. 10,000, there you go. Right. So that's all about recording the transition. Now what I can do, I can conclude the accounting equation and then I can conclude the income statement. And finally, I can come to SOFP, right? So let me quickly get the final figures of these columns, right? I think you might have done it, so I'll be quick with the calculations. Let me know if I'm having any discrepancies anywhere. 4,800, 600 minus 1,000. 4,400 is my PPE. 4,400. Okay. $350 plus 1,200 minus 700. 1,100 over here. Guys, correct me if I have made any mistakes anywhere. I hope I have calculated it correctly. 1,100, 1,022, 1,570 minus 945. I think there is a difference. Someone, right? Yeah, there is a small difference in PPE. It's 4,390, right? Sorry, I didn't look at this one. 4,390. It's 4,390. Right. Thank you. Right. Thank you, all of you. Most of you have corrected me there. Right. Now we are done. Now we can conclude the income statement as well. Let's quickly conclude it. Here it's 1,450. That's my sales. 700 minus 20. That's 680. My cost of sales minus. And my gross profit is 770. My gross profit is 770. So now here my other income is 750. And let's quickly add the expenses. 25 plus 200 plus 18 plus 600 plus 10. That gives me 853. So $770 plus 750 minus 853. That gives me 667, which is my net profit. Which is my net profit. Okay, good. So that's basically the answer for income statement. And finally, we are coming down to the SOFP. So how do we record how do we do the SOFP? It's pretty easy. All you got to do is to take the final balances. We have the final balances of each and every asset, liabilities, and equity. So what do we represent in SOFP? We represent the assets, we represent the equity, and we represent the liability. That's what we do. Represent the asset, represent the equity, represent the liability. So now we have taken the final balances. So all you got to do is to transmit these balances from your accounting equation to SOFP. That is what you should do. So now, when it comes to asset are of two types. We have the non-current asset and we have the current asset. And what is the clear-cut line between these two things? Non-current assets are long-term, current assets are short-term. The timeline is 12 months. The timeline is 12 months. If an asset is going to be used for more than 12 months, it's non-current. If it is less than 12 months, it's current. Same goes for liabilities as well. This is something you guys know. So now we have property, plant and equipment, 4,390. I have to put that under non-current asset because it is of long-term usage. 4,390. 4,390. Then we have inventory, which has a shorter useful lifetime. Therefore, it needs to be considered as current asset. That's 1,100. Then we have trade and other receivable, which is also a current asset because it has a shorter useful lifetime, 1,022. It gets settled within an year, within 12 months. Then we have cash, 1,570. Without any shadow of doubt, we all can agree cash is also a current asset, right? So those are the assets that we got. Let's move on to the liabilities. In liability, we have bank loan and trade and other payable. We all know bank loan is a non-current liability. So let me park that under non-current liability. That is 945. 945. Then we have trade and other payable. I already told you, payables are short-term. Trade and other payables, that's 1,440. And we have an equity balance, which is 5,697. 5,697. So that's it. Now, if we take the figures and sum it up, we will get our financial statements equal. Let's go ahead with it. So now let me take the current asset to the second column. 1,100 plus 1,022 plus 1,570. That gives me 3,692. 3,692 plus 4,390. That is 8,082, which is my total asset. Take the trade and other payable to the opposite side. 1,440 plus 945 plus 5,697, and that gives me 8,082. There you go. So that's basically the total discussion of this question. And let me tell you, I know most of you have attempted this question. To be really honest, this was the question your super seniors did in 2023. This is basically the question from your latest past paper, but I have not amalgamated, I have amended the figure. I have curtailed down the figure, made a bit of changes here and there, and I have made it even more difficult for you to do. And if you have done this, and if you have got like 80% of the entries correct, I think you are like way better. You are basically in a very good state as far as accounting equation is concerned. But to be really honest with you, most of the time accounting equation is going to get coupled up with another question like bank record, like they can put a biryani. We'll probably discuss those types of questions too going forward. So yeah, thanks a lot for joining. So there are a few things that I want to clear up to you. So you are basically in the month of December. Basically in 2 to 3 days time, you are going to get into December. So we are at the cliff of November. We are at the verge of November. We'll be starting of the December month in few days time. If you really think about it, you roughly have about an year or maybe less than a year to sit for the final exam, sit for your A-levels. So to be like really honest with you, if you can work hard from now, if you can be consistent with your hard work from now, you can go for a 3A pass. I'm not making this up. I have experience. I have taught for some students who literally started from their second year. They learned double entries, equation, accounting equation, all those things. They learned it from the second year. I mean, the start of the second year, and within a year's time, they were able to secure 3As. I'm not making this up. You guys seems to be like so good in accounting because most of you are like really interactive. giving me like good answers all the time, asking me some standard doubts. So I could see and witness that we've got a smart bunch of people inside this class. So all I want to tell you from my end, make sure that you utilize the remaining time that you got towards getting an A pass. Trust me, it is possible. All you got to do is to be consistent with your effort, because accounting is a skills-based subject. It is not like business studies where you sit down in front of the book and start memorizing each and every definition of it. Accounting is rather a skills-based subject. So how do you capitalize on a skill? Practice. No matter what sphere of activity that you may be in. It could be studies, it could be sports, it could be working out at a gym, or it could be, you know, building a business. It could be anything. No matter what realm of activity that you may be in, unless you practice, you can't capitalize on a skill. So you should practice. Practice is the key factor if you want to be an expert in accounting, not just in accounting, in every sphere of activity that you do in your life. So please make sure that you practice. And when it comes to practice, we've got two people. There are some people who practice occasionally. They focus on intensity and they practice occasionally. Now, what do I mean when I say occasionally? When the test is near, when the exam is near, they sit in front of the table and they cram all day long, 24/7. That's what they do. This way of working, it focuses on intensity. It doesn't focus on consistency. You don't continuously work. You work occasionally. If you do so, probably you will get an overwhelming pressure to your head. So this is something most of the boys do. They don't work from the beginning. They cram at the last point of time. Please don't do it. Work from the beginning. You don't need to study 10 hours a day, 15 hours a day. No, just study 1, 2, 3 hours, but make it consistent. Make it consistent. Consistent hard work guarantees success. Trust me, without a shadow of doubt. If you can put in the right effort consistently, probably within the given period of time, you will be able to secure a pass. No doubts in it. It's more like a snowball. It's more like a snowball. Working consistently, it's more like a snowball. At first place, it won't give you a lot of impact. It won't give you a lot of progression. But as you keep working out, as you keep working hard, it's going to give you big results. Think of a snowball, rolling down a hill. Okay. At first place, the snowball is, it's so small, right? It is so small at first place. As it rolls down, what does it do? It keeps gathering ice. It keeps gathering snow into it, right? Every time it rolls, it becomes bigger. Every time snowball rolls, it becomes bigger. So this small snowball, over time, as it rolls over again and again and again, it becomes one of the gigantic snowball. You know what I mean? Likewise, if you work hard, like consistently, every day, if you can work about 1 hour, it adds up to your next day progression. The progression that you make today, it adds up to the progression that you make tomorrow. So don't go and study 10 hours a day, but start with half an hour or start with 1 hour and make it consistent. It's more or less like going to gym. It's more or less like going to gym. You go to gym, work out 10 hours straight, no gain. Go the next day, work out 10 hours, no gain. But if you can work out 20 minutes a day, and if you can continue it for 365 days, within a year, you would have gained muscles. And studies are not of any exception. Your studies are not of any exceptions. If you want to go for an A pass, if you want to be good in accounting, if you want to thrash your exams with an A pass, all you got to do is to start from the beginning and work consistently. Don't wait until the last point so that you may cram. Don't do it. Work from the beginning. This time that you have got is way more than enough for you to go for an A pass. I wish you all the very best. This is something that I'm giving from my end as a teacher. So make use of it. I will probably meet you next Friday with weekly paper 3. Thanks a lot for joining, guys. Have a very good night. Assalamu alaikum, wanakkam, aibovan, vandanam, all of you.